Hi everyone, this is a super important video because in this video I'm going to share with you 10 tax saving investment options that will save you tax under 80C, and you can be able to save at least up to 1.5 lakh rupees of your salary or income absolutely tax free. With that, let's get this video started. Your first option is NPS, which is National Pension Scheme. NPS is the world's lowest cost pension scheme. Yes, world's lowest cost pension scheme. When it comes to returns, in the last 5 years, NPS has given anywhere between 8 to 11% annually, which is not bad at all. Now, you may have a question, why 8 to 11%, why it's not assured in returns? Yes, because it depends on your investment options or selections that you make. For example, you can decide to make your investments into equities or government securities or fixed income instruments and so on. So as an investor, when you're investing in NPS, you can choose where do you want your money to be invested in. Therefore, the returns will also vary depending on the options you make. Therefore, in the last 5 years, 8 to 11% on an average is the returns that NPS has given. When it comes to lock-in period, let's talk about it. There are 3 things that you need to know. You can withdraw your money first time only after completing 10 years in NPS, and you can only withdraw up to maximum 20% of your fund after completing 10 years. The second time you can withdraw your money will be at the age of 60, wherein you can withdraw lump sum amount of up to maximum 60% of your fund size, and remaining 40% you will have to invest into a pension plan that will give you monthly pension. But if you decide not to withdraw the money at the age of 60, that's absolutely fine. You can do that. You can carry on investing and you can withdraw your money at the age of 70. So that is all about lock-in period. But you can see in a summary that lock-in period in case of NPS is very long, right? Now, coming to the tax saving parts, NPS gives you the best maximum amount of tax that you can save on. So there are 3 components that I want to talk about. Number 1, under section 80C, you can decide to save up to 1.5 lakh rupees of your income or salary. On top, the point 2 is that you can also save 50,000 rupees of deduction under section 80CCD, right? And thirdly, if your employer decides to put 10% of your basic salary in NPS, that also become tax free, right? So in summary, what is happening with NPS is you should decide to invest in NPS only if you are happy to leave your money for longer locking period, and you are happy with returns of between 8 to 11%, and you also want the flexibility of saving maximum tax in the next 10 to 20 years. There is a lot more detail on NPS. So please let me know in the comments full video on NPS, and I'll be happy to create a separate full video on NPS giving you everything that is there for you to know about NPS. Moving on to our number 2 investment option, which is ULIP, Unit Linked Insurance Plan. When you're investing in ULIP, please know that you are paying premium, and your premium is going into 2 parts. Part of your premium is going into life insurance cover that you're getting, and remaining part of your premium is going into investment options. The great advantage of ULIP is that you as an investor can decide whether you want to invest your money in debt, equity, or balanced funds that have exposure to both debt and equity. Experts believe that in year 2023 and 2024, debt is going to perform better than equity. It is going to be more volatile in the stock market. Therefore, ULIP is a better option. Also, secondly, as an investor, you can decide that if you want to make changes from debt to equity or balanced funds, ULIP allows, majority of ULIP policies will allow you to do that. And that is again a great feature. Depending on the market conditions, you may want to decide to move to equities later on, or debt or balanced funds, which is a great feature of ULIP itself. When it comes to returns, in the last 5 years, ULIP have given returns between 8 to 9% annually, which is not too bad, little lower than NPS. But when it comes to lock-in period, in ULIP, you have minimum 5 years of lock-in period. You can partially withdraw the money in these 5 years, but you have to keep the money for at least 5 years, which is a benefit over NPS, because in NPS, as I explained in the last section, that it is longer lock-in period, but in ULIP, it is only minimum 5 years. Lastly, about ULIP, the 8 to 9% returns that you are going to generate, they'll be totally tax-free under the section 1010D. If you want me to again make full video on ULIP policies, comparing them, let me know in the comments, full video on ULIP, and I'll be happy to shoot a full video in upcoming weeks on ULIP. Option number 3 is retirement mutual fund plans. The way it works is that you will invest your money and there will be a mutual fund manager. They invest 40% of this money in equity market and remaining 55 to 60% money in debt funds. Now, the problem here is that you will have a mutual fund manager, but their expense ratio is really high, close to 2%. Honestly, it is a rip-off. I personally wouldn't recommend to put your money into retirement fund plan. Having said that, in the last 3 years, retirement mutual funds have generated between 7 to 13% every year. But please also know that the returns that you will generate will be taxed at 20% after indexation. So you will have to pay tax on the 7 to 13% returns that you will generate. When it comes to the lock-in period, you will have to leave the money at least for 5 years, minimum is 5 years. But before you buy any retirement mutual fund plans, please be aware, check the policy. So for example, Franklin Mutual Fund pension plan charges an exit fee if you exit the mutual fund plan before you turn 58, which is really long. So please be really careful with retirement mutual fund plan. I'm never going to create a video on retirement mutual fund plan because I totally am against it. But I'm again sharing with you so that you understand all of your options. Your fourth option is ELSS, which is equity linked saving schemes. My favorite investment options to save tax. I've created a separate video on ELSS. After this video, please go ahead and watch if you're interested in the full details of ELSS. But in summary, ELSS are mutual funds that invest minimum 80% of their money into equity and remaining 20% they can do whatever they like. Now, from ELSS perspective, the lock-in period is minimum in all 10 options. So it's only 3 years. That's why I love them. Secondly, when it comes to returns, they can give you anywhere between 10 to 15% on an average every year. But please know that the expense ratio in case of ELSS is very low, close to 0.50%, which is what I really like about them. Also, please know that the returns that you will generate out of ELSS will be taxable. You will have the long-term capital gain generated after 3 years and you will have to pay tax accordingly. Please note that Axis long-term equity fund and Quant are not the favorite ones because they have been performing Quant have been performing really well. Axis have not performed in last 1 year. I've covered in my video details about which are the top 3 ELSS funds that you should analyze further and invest. Last point I want to make about ELSS is that please do not choose one single mutual fund. Please split your money into at least 2 or 3 mutual funds to diversify. Fifth option is PPF, which is Public Provident Fund. If you want safe, secure, guaranteed returns, then PPF is for you. When you invest money in PPF, you open an account, you are going to get assured interest of 7.10% as of now every year, right? Secondly, people have a misconception that PPF has a lock-in period of 15 years. That is not the case. Please understand this carefully. Let us say you open your PPF account in year 2023, which is this year. After 15 years, which is 2038, your PPF account, you can withdraw all of your money. But in these 15 years, every year, if you're putting PPF, you are not getting 15 years of lock-in period on each of the money that you're investing. So for example, you make an investment in 2023, then you make in 2025, 28, 30, all of that investment you're doing, you're not having 15 years of lock-in period. It is considered from the date of opening your account, PPF account, after that 15 years, right? Second point is that actually you can withdraw some money after 6th year, okay? So after 6th year, you can withdraw some money. That will depend on how much of money you've accumulated, and you can withdraw up to 50% of the 4th year or the preceding year, whichever is lower, you can start to withdraw it. So if you want to have safe and secure interest rate of 7.10%, PPF is for you. Your option number 6 is Sukanya Yojana. This is only for people, taxpayers who have got their daughters which are younger than 10 years of age. In this, what happens is you can invest your money and you are going to get assured returns, but that will be dependent on the government bond yield. So for the month of January to March, right now, the returns that it is giving is 7.6%, which is not bad at all. However, these rates may change depending on the government's bond yield rates. But in the last 2 years, the government bond yields have been falling, but the Sukanya Yojana still is able to manage the same returns. It has not gone down, right? But we just need to be aware of that. Also, please know that from a lock-in period perspective, you will not be able to withdraw this money until your daughter is at least 18 years of age. And also please know that the maturity proceeds have to be used for your daughter's education or marriage. So it's only for those taxpayers who have their daughters younger than 10-year-old. Number 7 is private pension plan. The concept is very similar to NPS, National Pension Scheme, where NPS is backed by government, but private pension plan, as the name suggests, is only given by the private players. Now, when it comes to private pension plan, you will lose the 50,000 additional deduction that you get for NPS on top of 1.5 lakh rupees. You don't get in private pension plan. In fact, private pension companies have been lobbying for a number of years now to say that they should be equal to NPS scheme so that they can compete with NPS. But second point is that in case of private pension plan, please know that you're stuck with one pension manager, a fund manager. In case of NPS, if you're not happy with your fund manager, you can request to change your fund manager. NPS is by far very, very flexible as compared to private pension plans. It's a big no from my side. Please do not get trapped by any agents who are trying to sell you private pension plans. The returns, if you look at it in the last 5 years, 7 to 8% is what you're going to get at the max. And also, please know that the lock-in period is till retirement. There is no point in investing in private pension plan. I'm not going to waste your time, my time talking about anything more about private pension plan. All right. Let's now go to number 8, which is tax saving fixed deposits. I know you already know about it, but I had to include it in my list because it is one of the legitimate option for investing for tax-free money, right? 5 years is the lock-in period for tax saving FDs. Right now, the interest rate could be up to 7%. Please do your research on Google and find out which are the best paying banks. Let me know in the comments as well, so that people who are watching this video, they will get to see what your research says and you can get benefited from each other's sharing. Number 9 is NSC, which is National Saving Certificates. It's an initiative by Government of India. You can get assured returns in case of NSC. Right now, the interest rate is roughly 6.8% if I'm not correct. And they are all tax-free returns. But please understand how the tax-free returns work in case of NSCs. So for example, you put in 50,000 rupees in NSC scheme and you generate after 1 year, let us say January 2023 is when you invest now. And let us say January 2024, your interest is 3,500 rupees. Now you can claim tax rebate on this 3,500 rupees when you file the returns for next year. So you will have to claim for the tax-free returns in case of NSC returns. Lock-in period again is minimum 5 years. Again, if you want assured safe returns, then NSCs are for you. Depending on your appetite to take risks, you might want to consider investing in NSC. Number 10 is life insurance plans. Now, there are two parts to life insurance plans. Number 1 is the term plan and number 2 is the endowment plans. Term plans are very simple, where you pay premium to the insurance and you get a cover, but you get no money back. Your premium is gone. Okay, that is term plan. Endowment plan, what happens is you're paying premium, you're going to get a cover, life insurance cover, but at the end of it, you are also going to get money back. These endowment plans are total scam. Please keep away. 100 meters away, 2 kilometers away from endowment plan at least. All right. Now, let me explain you a very simple example. Let us say your age is 30 years right now, and you want a term plan and you want to cover your life for at least 1 crore rupees. You will only pay roughly 12,000 rupees every year as a premium. It is the money that you're investing to get a cover of 1 crore rupees in case of eventualities, which is the right thing to do. Versus if you buy an endowment plan, you're going to get maximum 40 to 50 lakh rupees of cover. And for that, you will have to pay at least 4 to 5 lakh rupees per year as a premium, right? Please do not do this mistake of buying any life insurance plan. Insurance means term plan, because that is what will give you the maximum coverage. You are covering yourself. So please never invest in life insurance plans. Always go for term plan. All these 10 options are not necessarily in the order that I've described. Also, a disclaimer that I'm not a tax advisor. Please make sure you do your own research. I've collected these 10 options with my research. And if you liked it, please press the like button. Subscribe to my YouTube channel, because I'm going to see you in my next video.